Yeah, so we have seen a tremendous amount of optimism in financial markets since the beginning of the year. Um, you know, about 12 months ago, we had the banking turmoil in the US, in Switzerland, and there was quite a bit of uncertainty. But since then, the inflation picture has improved. There is an expectation of a soft landing globally. And so the combination of an expectation of interest rates coming down across the globe, real activity slowing a little bit, but being away from a global recession, that has really fueled optimism. We have seen quite a bit of upside surprises to earnings, upside surprises to real activity in many countries. And so valuations have run up. Now, we do worry in some segments where valuations have become quite stretched. I would point to credit markets where spreads are very tight, even though borrower fundamentals are deteriorating, at least in some segments. So, even riskier borrowers are able to issue new debt, and that's at very favorable prices. In equity markets, of course, the valuation has been broadened. It was led by tech last year, but at this point, it's really across the board that we have seen a run-up in valuations. But there's always this question, if a negative shock were to hit, to what extent do we see a readjustment of pricing?
We've had low levels on the VIX for most of this year, really confounded expectations. The spike has now happened thanks to the geopolitics driving that VIX higher for April. Are investors forgetting we're not in an era of cheap money anymore, and global coordination has regressed from here, leaving assets vulnerable?
Yes, so what we worry about is the wedge between market implied volatility and fundamental uncertainty in the global economy. And in the global economy, of course, we see geopolitical frictions. There is still a risk of more persistent inflation, and there is interest rate risk as a result. And so there's a bit of a wedge between the market volatility and the geopolitical volatility that is out there. So the market volatility is driven by a rally across risky assets, so correlations are extremely high by historical standards, and hence market volatility is compressed. And at some point that has to recalibrate. Hopefully it's global political uncertainty that is coming down, but the risk is that market volatility is going to ratchet up, including the VIX.
How swiftly could asset prices move today? It feels as though we have a major event. Then you see very swift reaction. Is that something that investors need to be more mindful of than in the past?
Asset price adjustments often takes time to realize, but once they're realized, they're very quick. There's certainly quite a bit of room for readjustments. Now, having said that, many countries have been resilient to these kinds of readjustments. So when you think about the major emerging markets, for example, right, they have been subject to these global shocks, global pandemic, inflation, the ratcheting up of commodity prices that have them come down. And the major emerging markets really have shown a tremendous amount of resilience. Our view is that the better policy frameworks in terms of monetary policy, higher reserves, as well as better regulation of the financial sector has really helped the resilience of those countries.
Investors have certainly been hoping that interest rates are going to come down, taking pressure off financing costs. But the timing in the United States is being tested thanks to hot data that we've witnessed. You've pointed to less favourable financing conditions, an environment that's not as conducive, bringing risks. What are investors not paying enough attention to when it comes to the commercial real estate market?
Well, I do think that investors are looking at all markets broadly. We do see risks in terms of inflation persistence. Some of that has realized already, but of course we could see further surprises. We view risks as broadly balanced around the globe, but in some countries there's a little bit more upside and others a little bit more downside. So certainly interest rate risk is a key factor we are looking at. In terms of real estate, it's the commercial real estate sector that is somewhat worrisome. And there's really a nexus between bank exposure of some banks, particularly middle-sized and smaller banks, to commercial real estate that also tend to have a fragile funding base. So it's the combination of having a risk exposure to commercial real estate and this fragile funding that could, in some scenarios, reignite some instability.